Basel III recognizes that unallocated or paper gold and likely also silver pose systemic risk to the global banking and financial system. If the rules are fully implemented and adhered to, it could increase physical demand and boost the gold price. The Basel III Accord is a set of banking standards that are designed to improve balance sheets and reduce systemic risk in the global financial system. The standards were introduced after the collapse of Bear Stearns and Lehman Brothers, which triggered the 2007-2008 financial crisis. The rules were written by a supervisory committee of the Bank for International Settlements, also known as the BIS, which is based in Basel, Switzerland, hence the name Basel III. The rules were written for 28 of the world's central banks, and Basel III follows Basel I and Basel II, which came into effect in 1988 and 2004, which also established bank capital requirements. The BIS, by the way, is commonly known as the central bank of central banks.
Why are we starting to hear more about Basel III this year? What important dates do we have approaching? And, there have been some delays previously, so what's going on there?
Sure. Well, much has been written and spoken about lately about this accord, particularly in precious metal circles, because of an approaching June 28th rule change. The rule is called the Net Stable Funding Ratio, or NSF ratio. And it changes the way that banks classify assets and liabilities, or at least potential liabilities on their balance sheets. Only European banks are affected by the rule change scheduled to go into effect June 28th, not the American or British banks. British banks are set to implement the rule next January 1st. And in the United States, the rule is effective next month, though the large banks don't have to publicly disclose their NSF ratio levels until 2023. By the way, many countries have already complied with this new standard, notably Australia, Brazil, China, Indonesia, and Russia. The major Western powers, the United States, Great Britain, and Europe, are behind them in implementing this rule. It's important to note that the NSF ratio is only one aspect of Basel III. The accord includes a lot of other banking regulations as well, and those rules have different implementation dates. By the way, this is significant. Basel III is a voluntary regulatory framework. The rules aren't legally binding. It's up to banking authorities in each country to implement them. The Accord's implementation dates have repeatedly, as you mentioned, been postponed since the standards were proposed and finalized in 2014 and 2017, respectively. Last year, because of COVID, the overall implementation date was extended once again to January 1st, 2023. If that deadline is met, the banking pact will be phased in over 5 years through 2028, a full 20 years after the financial crisis the standards were designed to address. When it comes to regulation, the central banks move very, very slowly, and there's no doubt more deferrals of the deadlines are not out of the question. Well, if Basel III is fully implemented and adhered to, more banks should want to hold physical gold as an asset, as opposed to selling, leasing, swapping, or trading the unallocated metal or paper derivatives that are now used to manipulate the gold price. Under the Accord, physical or allocated gold is classified as a risk-free or zero risk asset, as you mentioned, the same as cash, equivalent to cash. As an aside, I would argue that physical gold has less risk or downside than cash, which loses purchasing power through inflation. Gold advocates have known this for a long time. They also know that physical gold has no counterparty risk, but it certainly is nice that the central banks are acknowledging the intrinsic and monetary value of physical gold. Now, contrary to the allocated or physical gold, unallocated or paper gold does carry counterparty risk and can be a liability. That's why this NSF ratio rule requires bullion banks to hold funds covering 85% of the value of the unallocated gold that they hold for their customers. The London Bullion Market Association, also known as LBMA, and the World Gold Council have objected to this rule change. They claim it will negatively impact the gold market, increase the cost of dealing in unallocated gold, and reduce financing for gold miners and refiners. We'll have to wait and see if the BIS caves in to pressure from the LBMA and World Gold Council. So far, they haven't, at least not publicly. Since the regulations are voluntary, the rule change is tenuous, even toothless, if you will, as it attempts to rein in unregulated financial derivatives. Basel III recognizes that unallocated or paper gold and likely also silver pose systemic risk to the global banking and financial system. As with alcoholism, the first step to recovery is accepting you have a problem. And the banking system has a big problem with financial derivatives. I once heard derivatives described as debt used as collateral to assume more debt. However, they're described, permitting debt to trade paper or imaginary metal. Sounds like a recipe for disaster to me. If the rules are fully implemented and adhered to, it could end precious metals manipulation, increase physical demand, and boost the gold price. If that happens, who wouldn't want to hold gold, especially as currencies lose purchasing power through inflation? I hope the central banks are ready to come clean and end the fraud in the global monetary system by imposing some stringent accounting rules and capital requirements. Maybe they will, but I wouldn't bank on it. For decades, the the Bank of International Settlements has helped central banks intervene in the gold market, allowing the price to be contained and manipulated lower. It all comes back to this issue of allocated versus unallocated gold. When gold is allocated, it has a specific titled owner. When it's unallocated, numerous individuals or entities can lay claim to the same ounce of metal. Right now, the central and bullion banks maintain a paper or fractional reserves system in gold in which the same ounce can be leased or swapped numerous times. It's an accounting trick that allows multiple entities to claim they own the same ounce of gold. If ownership of a single ounce of gold is claimed by multiple entities, how can it be considered an asset on multiple balance sheets? If Basel III is fully implemented and adhered to, the manipulation and accounting fraud could end. Market analyst Alistair McLeod, who you're probably familiar with, believes the new Basel III rules will end precious metals manipulation by making it too costly for banks to rig prices with unallocated or imaginary gold on the COMEX in New York and the LBMA in London. And I certainly hope he's correct. On the other hand, Chris Powell, Secretary Treasurer of the Gold Antitrust Action Committee, which has documented precious metals manipulation for more than 20 years, speculates central banks could find other ways to continue to suppress the gold price. Powell suggests central banks could grant waivers to certain banks or funnel money to bullion banks to cover the additional cost of shorting metals and dealing in unallocated gold. Regardless, McLeod and Powell both make plausible points. The truth may lie somewhere in between. I believe market manipulation eventually will end. It must end, though it may continue for a while longer, depending on if the world's central banks are ready for it to end.